Hello, everyone, and welcome to the US session brief. We're on Thursday, the 11th of May 2023, just gone past 2:30 in the afternoon here in Europe. That means we've just gone past 8:30 a.m. Eastern Time, New York, and that's when the data releases usually come through. And as it happens, we've just had the PPI and also the initial claims. So that's following the CPI numbers yesterday, which came in lower than expected. And it's likely that we were going to see a lower than expected PPI number two, and that's pretty much exactly what we've got. I'll go through the CPIs in a short while, but I just wanted to go through what we've seen here from the PPIs. So the PPIs, as you can see here, coming through lower than expected. I posted it inside the chat immediately. So 0.2% month on month, core 0.2. So you can see both the core and headline coming in lower than expected. What's gone higher than expected is the initial jobless claims. So the jobless claims, just to be clear on what these are and how they compare with NFPs. The jobless claims show the number of people filing to receive unemployment insurance benefits for the first time in the past week. So basically how many people lost their jobs in a given period. So it's used as a pretty handy way to see how the jobs market might be performing, or if it's weakening at all. And with my Bloomberg chart here, as you can see here, this is actually the highest reading since October of 2021. So it's smashed some of the previous highs out of the ballpark, and it's just suggesting that we are starting to see quite a few more job losses now across the board, despite the previous months. Remember, the previous months NFPs coming through quite hot, so it's pretty mixed right now as a result of the couple of releases that we've had. Because the jobs release on Friday looked pretty strong, but then that suggests not all is well with the jobs markets. That's why I posted there goes the jobs market. Some pretty interesting data, as I said. Certainly weakening inflation, that's good. Jobs market, still monitoring that one, because of course the Fed ideally don't want to be causing a deep recession, if at all. And there's still speculation and different analysts from different investment banks suggesting there will or won't be recessions. Anyway, enough of the actual releases. How have we seen markets moving and responding to this? We've seen the US dollar weakening. You've seen the S&P not really too fussed, really. That just sums up where the S&P is at right now. Very, very much range bound. The Nasdaq is the one which is pointing to the upside more so and breaking out of its recent highs. You can see the S&P really getting squeezed in here now, and all signs point towards some sort of breakout, because this kind of contraction, when you've got the resistance overhead, so there's pressure here, but there's also pressure from buyers to keep us above the 40.95 and also above the long-term ascending trend line. But it's getting to a point where you need to see where we need to see this break higher or lower. Is there enough there to move higher? Well, the Nasdaq is getting that break. Is that going to be the leading indicator, so to speak, of the S&P's next movements? Remember, a large weighting on the S&P is or are tech stocks. So weakness in the dollar because of that weakening in inflation. Remember, so that's why we're seeing the initial flow out of the dollar, albeit the price of gold is a little changed. Crude has been range bound over the past 20, 24, 48 hours. Well, so far this week, really, after that tumultuous week last week, real volatility. But this week you've just seen some sideways movement. No real surprise there. There's not really too much more to add. That 2000 level holding strong on gold. What else did I want to add today? Oh yeah, of course, we've seen the Bank of England, who have raised rates by 25 basis points earlier on, signalled further rate hikes. Their updated macroeconomic forecast show a terminal rate of 4.75%, which is another 25 basis points higher than where we are. ECB's Nagel this morning said 2 more rate hikes are likely ahead of the summer break. That would imply deposit rates of 3.75% ahead of the summer break. In the Americas, markets are remaining hopeful that US lawmakers can avert default despite little progress on talks so far. Blackstone, the private equity giant, is in talks with large regional banks about lending partnerships. Microsoft has told employees it won't raise salaries for full-time employees this year. Disney has beat on fiscal Q2 revenues and operating income. Takeaways mixed. The more positive commentary revolved around the continued strength at parks, improving DTC losses, traction behind cost control initiatives in DTC. So some interesting numbers coming out of Disney there if you do monitor Disney stock. There's no more releases today. That's all the major ones that we've just had. So I'll keep monitoring. There's not really been too much market reaction, to be quite honest. So we'll see how the rest of the day plays out, trades out, both the same. And yeah, I'll see you inside the chat room. Thanks for listening, and all the best for your trading. Bye for now.